One of my clients asked me about what would happen if Ripple listed on the stock exchange as an IPO. What would happen to XRP? He's a subscriber in my Slack, and he pays a membership fee. And this is the answer I gave him. So I just thought I'd put it on YouTube just for people to see. Thank you very much, Susie, and I hope you're well, and I hope you're living your life according to the way you want to live it. Please be kind to yourself. Please be kind to everyone. Please be kind to family and friends and general strangers, and just make it a much happier place, and animals. My poor Gussie's not very well. Yeah, I'm really sad about it. But anyway, guys, I hope you're all well. Thank you. Hey, Danny, thanks for asking that question. I thought probably the best way to explain this was to do a video, because just trying to write it in an email or even talking on the phone, it'd probably be a little bit difficult to understand. So the first thing I want to explain is arbitrages and hedge funds. Okay, what an arbitrager is someone in the market that buys and sells a security. They can do it in the same asset class, or they can do it in different asset classes where they can make money. So I'll give you an example. Say you buy a crypto, say you buy Ripple on Bitfinex, and you buy it at 50 cents, but then you find it's on another exchange at 54 cents. You can sell it on that exchange at 54 cents. You've just arbitraged between one exchange to the other. You bought at 50 cents and you've sold at another exchange at 54 cents. That's called arbitrage, where there's a mispricing between the same security on another exchange. And it happens in stocks, and sometimes it can happen, in different exchanges, particularly when you've got one stock that's listed on the overseas market in Germany and it's listed on the US exchange. Now, the same thing can happen where hedge funds basically arbitrage different asset classes of the same company. So let me just explain that. So when we talk about asset classes, there's now five asset classes. The first asset class is debt and bonds, which is bonds, debt, they call it, equities, which are shares, cash, property, and the fifth asset class now is cryptocurrency. Okay, so we've got bonds, debt, which are the same, equities, shares, cash, property, and cryptocurrency. So an arbitrager not only arbitrages, say, one stock or one cryptocurrency in the same asset class, they can arbitrage between the asset classes. Okay, that's the first thing I want to say. So, and the people that can do that arbitrage between the asset classes, in other words, buy shares and sell debt of the same company, or buy the debt or the bond of the same company and sell the shares, or buy the crypto of the same company and sell the shares, or whatever, are called hedge funds. Okay, now hedge fund, it's a bit of a misnomer, the name hedge fund, because a hedge fund doesn't just hedge. In other words, doesn't just use cash flow to offset and to have a hedge. They take on very, very large positions, and often directional positions. And what I mean by that is open positions, not hedge positions. So George Soros, who runs one of the largest hedge funds, quantum group of funds, you would have heard of George Soros. He's an $8 billion worth individual, very, very extremely rich. One of his funds is about $26 billion. Now, there was a story in 1992 where he sold the pound against the US dollar and nearly sent the Bank of England broke. And he did it through his hedge fund, which was Quantum Group Funds and Soros Fund. And he actually sold the pound. So he didn't actually have a hedge on. He sold an outright foreign currency trade. No different to you selling, Aussie dollars and buying US. You're not hedging it. You're not hedging it in the sense that you're selling something and something else is coming on the other side. So with these hedge funds, they can actually buy one asset class and sell another asset class. And that's really important. Not only do they look obviously mispricings in the same asset class, like the crypto world, i.e. one exchange the other, but they'll also look at mispricing in other markets, okay, and that's the key, like in the share market compared to the crypto market, compared to the debt market, compared to the share market, compared to the crypto market. So, and just this is just a bit of background so you understand. So some of the largest hedge funds, to put it in context, in the US are Bridgewater Associates. They have 103 billion, which is a lot of money. AQR Capital 63, Man Group 46, Two Sigma Investment 42, and the Soros Quantum Fund, Soros' Quantum Fund of 26 billion, but that's not talking about his own personal wealth, which is 8 billion, and he also has Soros Fund Management. So the hedge funds can go and do anything. They can buy and sell any type of security they like. Okay, so when we getting back to Ripple, say Ripple does an IPO, an initial public offering, the first time they come into the equity market with a prospectus, which is what they should do to be compliant with the Security Exchange Commission. They have an initial public offering where they sell their stock at $700 per share. At the moment, and with the initial public offering, they go to the market and they go, right, we have no debt. We're a technology company. We're a blockchain crypto technology company. We smarter than anyone else. We've got the best settlement processes. We've got the best clients, whatever. We have 25 billion in the bank, which is what they have. We have great clients. We've got great revenue, and we've got fantastic growth prospects going forward. And so they can do an equity IPO, initial public offering at $700, and they pay a dividend on the stock of 2%. And they only pay a dividend once a year, okay? Say at the same time, not that they need to, but just to show the illustration, say at the same time they issue a bond into the market, that even though they don't need the money, but they do just for the argument's sake, and that bond pays a 3%, issued at par, which is basically the yield's at 3% and so is the coupon, issued at 100, and they pay 3% every 6 months. So the yield on that bond is basically 6%. And say at the same time, XRP is at 54 cents. Okay, so this is all happening, say, today, right? So say we hold those things for a year. Okay, so we go to the next page. And just keep that in mind. So we've got equity of $700 that pays a dividend only once a year at 2%. They've got a bond. Sorry, I'm spelling it. They've got a bond. They don't need the money, but they do have a bond out there, which is a 3% coupon return, semi-annual. So it's actually a 6% return. And they've got XRP, which is at 54 cents. Okay. So by the end of the year, so that's what they currently have. By the end of the year, the return on the bond, if I'm an investor in that bond, is 6%. If I instead invested in the stock and there was a capital gain on the stock and the stock went up to 800 from 700, my return on the stock is 100 over 700, is 14.29% plus my 2%. My return is 16.29%. Okay, so if I invested in the stock, it'd be 16.29%. If I invested in the bond, it would be 6%. So basically, I'm better off to have invested, obviously, in the stock, okay, rather than the bond, okay. Oh, the bond was 6%, sorry, don't want to confuse you here, rather than 6%. For the same outlay. Okay, just keep that in mind. So if it was only between the two asset classes, bond or stock, I'm better off as an investor investing in the equity, because the equity is giving me a 16.29% return, whereas the bond is only giving me a 6% return, okay, as a fund manager or a hedge fund manager, or even as a private investor. Okay, so keep that in mind, just so you understand. So we've got this situation where that's what happened in year one. Now next year, year 2, we believe that the same scenario will happen again. If anything, if it's a good year in equities, this could go up to 25%, right? The return on the equity. And the bond's still going to stay at 6%, assuming rates don't change that much. All right, but we still have our crypto at 54 cents. So we're hedge fund managers, and we go, you know, we're going to get maybe 25% on the return on stock, including the dividend, 6% return on the bond, but we believe the crypto should be priced at $334 because we believe the stock, you know, should be around 1,000. And if the stock's around 1,000 US, then the crypto at 54 cents is too cheap, because the crypto is just another funding tool, okay? It's another funding tool to get money in. So next year, we believe that this could go from 54 cents to 334. Now, if it does, we're going to, as a hedge fund manager, get a return of 62,000%. Even though we know the crypto market is a lot more volatile than the bond market and the equity market put together. If we invest in equity rather than the crypto market, the most return we could get is, say, 25 to 50% max. Generally, the average return is about 25%. And we know that if we invest in bonds, we're going to get 6%. So as a as a hedge fund manager, I'm allowed to buy and sell Ripple's securities anywhere, in any asset class. And going back to this first slide, the asset classes are bonds, equity, cash, property, and cryptocurrencies. So as a hedge fund manager, I'm doing all my fair value models and all my target models. I've got my analysis people analysing their debt securities, their equities, their cryptocurrencies. They've gone through the company, the technology, and my credit analysis team, my analyst team, my equity guy, and my credit girl have said to me, crikey, you know, the crypto is too cheap given where their bonds are and given where their stock is. So they've made a recommendation to me as the hedge fund manager and said, we need to buy the crypto market, the cryptocurrency, because it is too cheap. So what we do, we go, yes, that's right, that's a very good idea. So what we do, let me just move that, it's in the wrong spot. So what we do is we decide to sell our bond, sell our equity, and get into the cryptocurrency, say. So say we had $100 in equity, 100 in bonds, and we decide to reallocate all that to the cryptocurrency. So 100 in bonds, 100 in equity. We sell that, we're negative 200, sorry, we're positive 200 here, and that then goes into that, we're negative. So we've sold that negative, and then we're positive because we're investing in the cryptocurrency market. So we've reallocated as a hedge fund manager out of bonds and out of equities. And if we're right, this return is going to be 62,000% return, and our opportunity cost is only losing 25 and 6%. So our overall return for that investment is, because we switched out of bonds and equity into that, is about 69.30% return. So what the arbitrageurs do is they decide the equity is nearly fully priced. We don't think it's as cheap as it was. The bond, you know, is pretty thinly, you know, it's a thin interest rate. In other words, we're not getting a very high interest rate because it's such a good credit. So the bond's expensive, the equity is expensive, but the crypto is very cheap for the same exposure in the company. Even though the asset class might have more risk connected to it in terms of volatility, the return is worth the amount of volatility. So what an arbitrage will do, a hedge fund, they will sell all the other asset classes that belong to Ripple to buy the cryptocurrency, which is cheap. So they will short sell equity, short sell the bond to buy the crypto for the same exposure. But what they've done is they've selected the specific asset class. So they've short sold the equity and the debt, minus 100, minus 100, and they've invested that plus 200 into the crypto market. You see what I'm saying? So they can actually generate cash from the equity market to invest in the crypto. Now, a lot of people don't understand that, but when you're a hedge fund manager, you can actually, they call it a stock repo. You can actually short the stock on repo. It's a repurchase agreement. Get cash in and pay for the cash. It's a very cheap cash rate, and use that cash to go and buy the cryptocurrency. See what I'm saying? So the minute they do an IPO, a lot of people don't understand this, the stock will be available. They can shorten, they can sell the stock and get the cash, whether they have it physical or not, it doesn't matter. They can do a stock lending, a repo, short the stock, get the cash, and basically use that cash to buy the crypto. And by that, it drives the price up. And they don't necessarily need to own the cash. They can borrow the cash between the equity market and the cryptocurrency market. I hope you understand that, because it's high finance, but that's exactly what will happen. And that's why I'm absolutely convinced that XRP will go to that level the minute they do an IPO. And I think their IPO would go on at $600. If Google's $1,000, whatever it is, I haven't checked recently, I have no doubt in my mind that Ripple would go on at, 600, 700, something like that. Anyway, mate, I hope you understand that, and come back to me if you've got any questions. Thanks.